Hey everybody, Chuck Gibson from Financial Perspectives here with the monthly market wrap for April 2015. As much as I wanted to spend a little more time in this report on things outside the United States, as they've been way more interesting, in order to keep the video to under 10 minutes, as with past months, the majority of the content will be looking at the U.S. markets. Let's jump right in. The broader U.S. stock market has gone virtually nowhere over the past 5+ months, while individual stocks have had a split personality. Either they report good results and they move up accordingly, or the reports disappoint and investors react severely, pushing them down 10 to 20% overnight. This, combined with a constant in and out sector rotation, had made this one of the most difficult stock markets to invest in that I can remember. To compound the problem, bonds, which are supposed to be the anchor and counterbalance to stocks, they got too far extended and are currently correcting. While the stock correction has so far been sideways, the bond correction, as you will see further down in this discussion, has been one of a decline. Everyone hates market consolidations because nobody makes money, and this time is no exception. It is my expectation the markets will continue to confound and frustrate investors likely through the summer as we are entering a time of seasonal weakness. Taking a look at my first chart of the total U.S. stock market, there is no question this could be the poster child for the image of what a strong bull market is supposed to look like. It is held nicely above its long-term trend line, and while momentum has been waning since the start of 2014, it's still well within the bullish zone. The next chart is the U.S. small caps, which was the first sector to begin consolidating starting back in early 2014. You can see that consolidation ended in January of this year as it broke higher, but is now backtesting the red horizontal support line. You can see in the bottom pane where I compare the small caps to that of the largest 500 U.S. stocks. They bottomed in October of last year and have been grinding higher, outperforming ever since. It's important to remember small caps are usually the market leaders. As such, they should be followed closely because what they're doing right now will typically be what the rest of the market eventually does. They tend to lead you into a correction, but are also the first ones out. If we use this knowledge and extend our look further out, I would expect to see the large cap stocks follow the small caps lead and break out to all-time highs later this year. My next chart is that of the biotech sector, which has clearly been the market leader since the 2012 bottom. For those that remember almost 20 years ago, they remind me of internet stocks of the late 90s. In this long-term weekly chart, you can see that it has created two uptrends. The first is a more conservative blue line, which was established at the 2012 bottom. And the newer one is the steeper red dashed line, which was established early last year. It's critical to remember that as long as price stays above both of those lines, this sector is still considered to be in an uptrend. Doing a quick sanity and gut check, investors need to accept that because of how far price has moved away from both of those lines, a further 15% correction, on top of the almost 10% correction we saw in the past 2 weeks, could occur, and it's still bullish. The question each of us needs to ask ourselves is, can we handle that type of volatility in order to reap the performance reward? This is definitely something to ponder as we see increasing volatility. This next chart, which is that of the monthly U.S. sector performance, helps illustrate how much this market has been in flux. As you can see, energy led to the upside in April with more than a 5% gain for the month, while healthcare was the big loser, coming in with an almost 2% loss. Now, contrast that against what happened for the entirety of 2014 and even into January of this year, where just the opposite was true. Energy was the big loser, and healthcare came in at number one to the upside. Unless you're in a constant state of rotation and are able to adeptly adjust to the market's whims, it's becoming increasingly difficult to navigate this choppy market. In my experience, it's much easier to make money in a market that is rising or falling. Sideways markets are virtually impossible. The good news is our model provided an excellent buy signal on the energy sector breakout, which we were able to take advantage of for those investors who don't have an aversion to the sector. We added 2 positions which are both up nicely from our entry point. As you would expect, knowing that energy led to the upside, and that it is the largest component of the commodity index, as you can see in my next chart, the broader index had a healthy bounce higher after forming a divergent low back in March. We are currently hitting at short-term resistance, and for this index to continue higher, there will need to be an impetus for it to do so, as it is fighting against a current downtrend. When I ask myself what could be motivating energy and commodities higher, the first thing that comes to mind is go check out the dollar, as they tend to move inversely. Moving on to a chart of the US dollar, it becomes clear that much of the recent performance of almost all markets has been related to the movement of the dollar. The almost parabolic breakout of the dollar mid last year coincided with lower US bond yields, higher US stock prices, and lower commodity prices. You can see that the dollar got extremely overbought and is currently consolidating, having lost about 5% from its high so far. Consolidations allow for investments to work off overbought conditions, and the dollar here is no exception. The charts are saying that to expect the dollar to continue higher once this consolidation is complete. I want you to keep this last thought in mind, because it's important to realize that this consolidation coincides exactly with a counter-trend bounce in commodity prices, a counter-trend bounce in U.S. bond yields, and a consolidation in U.S. stock prices. If I'm correct in my thesis that the dollar is just resting and will resume its trend higher at some point later this year, I expect commodities to continue their downdraft while bond and stock prices continue to rise. Why I bring this up is that any position we have taken that is counter-trend, such as in our energy investments, will likely be short-term. Obviously, we prefer to find investments that will be in long-term trends so as to minimize activity. We don't determine when the trend ends, we just react to what the market provides. To close out this video, the final chart I want to look at is that of the monthly S&P 500 US stock index. What I see is something that is in a beautiful uptrend. What do you see? Just 4 days ago, the S&P 500 made a new all-time high. Where was the S&P 6 days before that? Right where it is now. It may turn out to be the start of a correction or even the top. But I don't know about you, but I'm really tired of the fact that every down day we have in the markets, somehow, somewhere, someone declares either we have just started a 20% correction or they're calling for a top in the markets. Give me a break. Don't get me wrong, I'm not a Pollyanna permabull, as I see a lot of signals that are flashing warning signs. In fact, we may look back months from now and say that this was the top, but we're not going to know that until sometime in the distant future. My opinion, for what it's worth, is we will likely look back and say that this was just a correction within the context of the uptrend, but no one knows what the future will bring, including me. My opinions and recommendations are formulated based solely on probabilities only, not of knowledge of the future. But the fact is, the entire way up from 2009 bottom, warning signs have been flashing, and there have been top pickers the entire way up. This is why I learned to be a successful investor, you can't have a bias. You can't listen to people who predict where the market will go, and instead, and most importantly, you need to adhere to your process, which filters out all this noise and allows you to stay in the trend. I challenge anyone that is looking at this chart and see it as bearish, please contact me, because no matter how objective I try to be here, there is nothing that is right here, right now, telling me this bull market is over. Human psychology being what it is, we will always find data to support our view, even in a bull market and against overwhelming evidence. As Greg Harmon wrote, the media model of selling eyeballs encourages wild and stunning predictions, making it even harder to shut out the noise and think objectively. Please, give it a try though. Ask yourself the simple question. Does it make sense we can move from an all-time new high to a bear market in 4 days? I'm open to all possibilities, but personally, I'm going to wait for the evidence. Well, that wraps up this month's video, and I thank you for your interest and look forward to talking to you next month. This has been Chuck Gibson at Financial Perspectives with the April 2015 Market Wrap-Up.